All right, we're looking at Stitch Fix. Okay, stock 27-ish. What's the expected move for this week, everybody? Okay, I'd say we're right at about $5.50 or so. Okay, so we can look at this in one of two ways here. And I'll put this up on the whiteboard. Hang on. Today is the 10th. Okay, the stock is right in between two strikes. Okay, so if we look at the 27 straddle, that's trading $5.90. Okay, and that's just a matter of looking right here and right here. So roughly $5.90. Okay, everybody see that? Yeah, we're looking at the 27 strike, Dimitri. So the 27 call, 27 put. It's right about $5.90. Okay, everyone see that? Okay, so we want to calculate the amount of premium, though, not what the straddle is actually trading for, but the amount of premium in that straddle. Okay, now we can actually look. Stock has changed, obviously dynamic marketplace. Now the stock's 27.5. We could look directly at that 27.5 straddle right now and come up with 570 as an expected move. Okay, but if we were to go back to that 27 straddle that was trading $5.90 with the stock trading 27.20, okay, how much extrinsic value or premium is in that straddle? Okay, back out the intrinsic value and how much is in that straddle. Bingo, Dimitri. All we do is back out the 20 cents of intrinsic value, brings us right to 570. Okay, everybody see that? Same thing that we just calculated. Well, we don't know if it's a lot or little. We're just calculating what the market is pricing in right now. That 570 is basically the same as what we're seeing now with the stock 27.5. So that's the expected move on earnings. So what the market is predicting is then the expected range is 21.50 up to 27.20. I'm sorry, not 27.20. Up to 32.90. Big range. Big range. But that's what the market is expecting. Okay? Basically a 20% or so move in the stock. Yeah, IV is really high. You know, look, it's right up here. Just looking at the chart, really high. Okay, so let's take a look. At a stock screen and say, okay, right around those areas of 21.5 to the downside and roughly 33 to the upside. What's there? Anything there for us? Well, to the downside, 21.5. Yeah, I mean it's at the very, very bottom. Very, very bottom of this support area down here. 32 on the upside. I mean, not a lot. You have the gap from last earnings, which comes in just above that. I'd say that would be pretty significant resistance. Okay, so from a technical standpoint, you definitely have support around 22, and I'd say, first line of resistance on a big move to the upside would be about 34. So big support, 22, and gap resistance at 34. Let's see what the market is showing here. Let's see what we can price out. Okay, certainly from a directional standpoint, to me, this would be as much of a crapshoot as anything, right? This thing is just traded in such a tight range since last earnings. So without looking at anything further from a fundamental standpoint or any stories that are out there or anything like that, I would absolutely be inclined to say, what? Yeah, iron condor, maybe a strangle swap if volatility allowed us to do that. But something that you're looking for range-bound, non-directional sort of trade. So let's see what it looks like. So line up with a calendar, okay? If you look for a calendar with either on the call side or put side just in and of itself, you're actually taking a direction. If you're looking at both sides, so both a calendar put spread and a calendar call spread, then you're looking at either side. Okay, but from a volatility standpoint, if we look at a calendar, look at a strangle swap, we got to make sure that the vol we're buying is not completely overinflated compared to the vol we're selling. Okay, so let's first look at the iron condor. Again, looking at coming down to the expected range areas. So 21.5-ish and 33. So let's say we were going to look at, I don't know, something $2 worth. Throw out there first. 23.21 and 32.34. Okay, we would want that to be right at $1. Okay, right now, it's fairly wide market, but it's showing right in that range, 95 cents or $1. So let's put this up here. The 23.21 and 32.34 iron condor. Let's say we could get it for $1. I'm not saying that we can. Let's say we could get it for $1. That puts our break evens at 22 and 33. Okay, now little bit light on that break even to the downside compared to the expected range, which was down to 21.5. But if you recall, that big support is all right here, around 22 to 23. So I think that's pretty good. Now on the upside, the 33 coincides great with what that expected range was. I'd love, honestly, to see if we could get a little bit more room to the upside on a break even, just because of that gap fill there. Not saying that we need to, but if we could extend those strikes just a little bit. That could really help out on our break evens. So what I want to do then is not be complacent with these strikes. Since we know that, looking at an iron condor right now, since we know that at least at this point, the pricing might be where we want it to be, right at that 1-to-1 reward to risk, let's just start fiddling with the strikes a little bit. Okay, if I'm willing to raise the strikes on the downside because of that big support around 23, then that would allow me to also potentially raise the strikes on the upside and get more protection on that upside. Okay, so here, this is now the 23.5, 21.5, and 33.35 iron condor. Let's say we could get that for $1. So we've sacrificed a little downside protection, but we've picked it up on the upside. So the comparison now, okay, from before, we gave up 50 cents of protection on the downside to where the break even is, but we picked up $1 on the upside. If we could do that at 1-to-1, to me, that's pretty opportunistic. Everybody see what I'm talking about here? Okay, so I really like this, but we haven't looked at the calendars or that strangle swap yet. Okay, we know volatility is high, but maybe we can find something that works on both sides. So I like this iron condor setup. Okay, we have it on the back burner here. We know the strikes that we like, at least to where the stock is right now. So let's erase this. And now let's look at the break-even areas. So let's look at 22 and 34. Can even go to 35. Let's look at 22 and 35 to see if there is any sort of decent arbitrage, decent vol play, swapping both of those calendars. Okay, so that is 22 and 35 of this week, going out to 22 and 35 of next week. Volatility is so expensive right now, but, and we had this discussion a little bit on Thursday. Vega is so small relatively on each option, which is why that makes the implied volatility look so expensive. Now, I'm not saying that it's not expensive. It is. But when you're looking at Vega numbers in the pennies, okay, sometimes it can kind of take the implied vol out of proportion a little bit. But let's see what we got here. So this strangle swap, 22.35, probably costs us, I don't know if we can get it for 35 cents, but let's say we could get it for 35 cents. We know that's going to be zero. So let's say we could buy this thing for 35 cents. Okay? Let's see what the risk chart looks like. Okay, here's what it looks like tomorrow. So really flat, probably right in line with where we've priced volatility. Not great. Even if I move ahead all the way to Friday's date, so almost taking all of the premium, all of the theta out of the short options for this week, the risk analysis doesn't look great here. It does look really good if you get the move all the way down to our strikes, or all the way up to our strikes. But the fact that we would have to wait a few days or even more so to get all of the short theta, the theta that we'd be collecting in our favor, the longer we wait to collect that theta, what is the offset to that? What is the risk we have to that? Anybody? Paul, you mean aging like we're going to age? Like I'm going to get more gray hair between now and Friday? Okay, so Tony, the time decay on those short options will be working for us. But remember, we still have long options that expire next week. So the course of the matter, or the fact is, that the longer and longer we would wait to exit this trade, implied volatility is going to keep coming down. So rather than evaluating our long options at these implied vol levels, which is probably where they would be tomorrow and maybe even Wednesday, by the time we get to the end of the week, looking at our volatility graph here, I don't think we can assume that vol is still going to be here in the 80 to 90 range, right? Which is still towards the top of the area. I think it's, conservatively safer to assume that we're going to be down probably somewhere around here. in the middle, maybe even to the lower end of the volatility range. So what I really need to do then, to be conservative, to be fair in my assessments, is I want to lower this vol down even further. Okay, and now if the risk analysis looks good at the end of the week on these volatility levels that I have absolutely now crushed, now I would consider it. But now you can see, although it still looks pretty good, it's not nearly as good as it was with the higher levels. Now, if this was a guarantee, right? If we knew that we could put this strangle swap up on and close our eyes and wait to Friday, and this was the risk analysis, this was the P&L, if we knew this was set in stone, we would have to do this, right? I mean, how could we not? If this was accurate and saying, well, if we can wait, and here's what our risk is, but this is what our potential profitability is, how could we not do this? I'm not willing to do that. I'm not willing to put this position on and just kind of, put it aside, and then make a decision on Thursday or Friday and say, all right, this is what it was supposed to do. Did it do that? Are we there? Right? When we put positions on typically for an earnings event or some other big event where we know the stock is going to move, we want a more immediate action. So Lionel, if you're looking to in the green, 10% move would be here and here. But remember, that's not a 10% move overnight tonight. That's a 10% move out to Friday if we were willing to wait. This same graph overnight now looks like this. Haven't changed anything except the date. This is what it looks like tomorrow. Then when you factor in all of the extra theta, all the extra decay going out to Friday, then it looks like that. Great. I don't want to wait till Friday. Too many other variables. From a reward to risk timing perspective, if we could go back and if if we could recreate that iron condor and it's still at the price level that we had evaluated, I think that's what we want to do. Well, Tim, I don't necessarily agree with that. When you say 10% is a lot to hope for. And why is that? The market is telling us something different, right? The market right now is telling us they're pricing in a move of 20%. So I don't think a 10% move is a lot to hope for. In fact, I'd be willing to make, to make a wager that between now and Friday, this stock is going to be at least 10% away from where it is right now, one way or the other. Not picking any direction. Everybody following me? Everybody making, is that making sense? So what I want to do is I want to go back now to this iron condor, the second one that we had looked here. And let's see where the current market is on that thing. 23, 21 and a half. Sometimes I feel like when my voice is kind of hoarse and raspy like this, Sounds a little bit like Chris Collinsworth talking last night. Okay. Market has widened out a little bit from earlier. Not much, but widened out. But the price of this has also gone up. Why is that? What is different? What is different about us evaluating this now from 15, 20 minutes ago when we were evaluating this iron condor? Strikes are the same, but the price is a little bit more expensive now. You know, Don, I don't think so, just based on what I've seen with other stocks right now. So what changed? What changed the value of this iron condor from just 15, 20 minutes ago? No, no. What else? Take a look where we were before to where we are now. Right, Satya, volatility was down though from where we evaluated it before. That would make the value of the iron condor go down, not up. Bid ask is almost in the same place. It's a tad wider. Okay, there we go. Look at this. Now this just went down because the bid ask down to 95 cents. So that was part of it. The other part of it, though, when we were evaluating it before, guys, we started with the stock 27.20, then it went up to 27.50. Now it's down to 27. That's one of the reasons why when we evaluate these earnings plays, especially the iron condors, that I like waiting a little bit till later in the day to have a better handle on the expected move in the expected range. Okay, does all that make sense to everybody? Okay, so the outcome is you're probably all thinking, all right, great, we just discussed this for half an hour. All right, what the hell are we going to do, right? So what's the answer to that, folks? Okay, Don, you say wait. I think that's a prudent answer. Okay, Michael, same thing. Remember, the risk at waiting, as we have witnessed on many of these, is that the further we wait in the day to maybe put one of these on, we typically get less and less premium. right? Comes out a little bit as the day progresses. So the prudence of waiting to get that starting point and to get that expected range kind of locked in a little bit better. There's always trade-offs. There's always reward to risk in every decision we make. So the prudence in that, we run the risk at not being able to collect as much premium. Okay, any other questions, comments, thoughts on this? Because I am going to wait. I'm not going to put this out now. But half an hour from now, we'll recheck if it's still there. We'll probably put that out. Okay, any other questions before I wrap this one up and get it posted up in the room? Don, thanks for bringing up Stitch Fix. Certainly interesting. What do the bigs say about the stock I check? I don't understand that. You talk about bigs meaning, oh, blogs. Okay. Gotcha. Let me take a look here. Here's what to expect from Stitch Fix. Outlook. Okay. 12% jump. All right, so nothing of note in that article I saw. And when I search these articles, guys, what I'm really looking for the most part, is what the company has said about future direction. Have they raised or lowered their own guidance? And what have analysts done recently going into an earnings announcement? Those are the types of things that I look for. And I'm not seeing a lot out there right now, Don, in those blogs. All right, let me get this thing wrapped up. I'll get the video up on the screen, and I will get, here's going to be the whiteboard. Let me put that up here. Those of you that are new to the room, what we do when we have these discussions that are recorded is I will post up in the room, which you'll see here momentarily. There is the Stitch Fix whiteboard, so you can always refer to this whiteboard. And then I will also post up this entire recording for your review.